Interesting days. This is an update on the new Scope 3 standard that's in the pipeline. It's due to be released in 2028, but the implications are really important for now, from a strategic planning and preparing for it. So what we're going to do is just going to go what's changing, why this matters. We'll look at the implications, and how best to prepare for that. So if I have the next slide, please. So the current status, those of you who live and breathe greenhouse gas accounting protocol, it was drafted a number of years ago. It hasn't had that many iterations. They're doing quite a bit of work on Scope 1, Scope 2 at the moment, market-based, and Scope 3 is obviously the big animal. This is where the majority of everyone's emissions are. And obviously that's, in terms of the journey towards a net zero economy, it's the Scope 3s that really have to be worked on. So that's why it's such an important area of focus. What is changing is in terms of data quality and allocation. They're really tightening up on that, or they're proposing to tighten up on it. So it's in consultation at the moment. It's had one technical review. We can share those papers with you. It'll be out for another one. Looking at the review papers, it's getting mid-80s, early 90% support for the changes they're proposing. So you can pretty much read between the lines. These things are going to come and be the new standard. So mandatory disclosures on the level of specificity. So what they're doing is they're going to really tighten up on the quality of your data, and they also are going to be requiring you to state whether it's been verified or not. So again, that's to give some optics around how good are the numbers and behind of what you're saying. A big change is, and it sort of goes hand in glove with CDP reporting and science-based target initiatives, is this new 95% threshold for inclusion of Scope 3. So in the past, the Scope 3 guidance is you could choose what to include or what not to include. You could just give a justification why it's not relevant for you. Those days are going to be gone in a couple of years' time. You have to report pretty much everything unless it's under a 5% materiality threshold. So there's probably quite a number of Scope 3s, maybe it's capital goods, that in the past you haven't been reporting, and it's likely going to be, it's now going to be in. So that's something definitely to have a look at. And then if you are going to exclude anything that's below that 5% threshold, you've got to give a really robust reason why it's excluded, and you pretty much have to provide the maths to prove it as well. There's also going to be an introduction of a new category 16. So those of you familiar with Scope 3 as they currently are, the subcategories 1 through to 15. 15's investment. They're going to unbundle 15. So to pick up, they're calling it facilitated emissions. So things like underwriting, insurance, share platforms, those sorts of things. But what they're also doing at the same time in the past, Scope 3, 15 investments, it was limited to financial institution, banks, and such like that. That's going to change as well. So if you've got any investments as a corporate, you're going to need to report those under category 15. And so that's sort of the bigger changes. If we go to the next slide, please. And yeah, why does it matter? So look, no surprises. Scope 3, as mentioned before, it's by far the largest category. Some businesses, it can be up to 95% of their total greenhouse gas inventory. And that's why they wanted to capture that. Well, that's why they're expanding it to 95% of your Scope 3s. It is inherently difficult to account for. Traditionally, everyone sort of approached that as a start off using a spend-based approach. That's not going to cut it in a couple of years' time. they really are going to be mandating to move away from spend-based, unless it's just really, use the term rats and mice. They want to get into the numbers behind the embedded carbon. So, and that's an interesting challenge for procurement. We'll come on to that. And obviously, it's linked hand in glove to that transition to a net zero carbon economy. So it's about managing that the broader scope 3s across the whole corporate value chain. Next slide, please. So implications for corporates. This is probably the key stuff. And the good news is you've got a couple of years. The bad news is you've got a couple of years. So some things will take a bit of time to implement, but if you can certainly start thinking about that now strategically, you're going to be in a far, far better place. So overall, there's a requirement to improve the quality and completeness of emission data. So as I mentioned before, looking at those, looking at all your scope 3 categories and quantifying those, confirming if they are, if they still are de minimis below that 5% threshold, and then being able to prove that and justify it. So those of you who've gone through the likes of a SBTI submission will be familiar with that exercise. You just need to repeat that again. The strengthening system governance, controls and governance. This gets really interesting. So particularly around your procurement management systems or your materials procurement, is in the past you may have having within your current platforms that you're using, it'll be what's the material and how much you spent on it. That needs to prepare for 2 years' time. You need to start gathering, what's the kilograms of the goods and what is the goods itself. So there might be kilograms of or tons of steel, or it's kilograms of printing paper. You need those metrics to be able to meet the data quality requirements going forward. So if you haven't got that in your procurement management system, start talking to your teams around that and about getting that built in, because that's the piece that's going to catch a lot of people out in a couple of years' time. They're also looking to increase collaboration across the businesses and value chains. So what they're looking at is really that joined up corporate value chain. And I should have mentioned, and I apologize, I should have mentioned before, one of the other rules they're proposing is to, in terms of the boundary approaches, they're going to drop equity control as a means of setting organizational boundary. It's either going to be operational or financial control. So if you are currently reporting under an equity control, you need to start looking at that now. And the other, as I mentioned it before, is they're going to introduce the requirement for you to make a statement on whether your scope 3s have been verified or not. And then lastly, what impacts there is reviewing the targets and transition plans. It sort of goes hand in glove with rebaselining as well, and that you've got to, this is definitely a change in accounting processes and methodologies. This would trigger a baseline, particularly if there's additional scope 3s that you've never reported in the past, and under this, in a couple of years' time, you're going to have to start reporting it. It would definitely be a trigger event. Next one, thanks. So how to get ready? Probably first thing to do is just review those your scope 3 boundaries. So if you are under equity control, you need to have a good look at that and decide whether you're going to go for operational or financial control going forward, and prepare for that. You also need to look at which scope 3s for me. So you need to go through that exercise of looking at all 15 subcategories, or 16 is going to be, of scope 3, and getting some quantum around them. So you need to get the numbers for that first, and then go through that exercise of whether you can actually be able to demonstrate it's de minimis, and and think in terms of demonstrating that via an auditor who would say, yeah, I agree with that statement. Next piece is understanding the data quality. So if you, particularly around goods and services, as a lot of us are, if you're taking a spend-based approach, that's not really going to cut it going forward. So you need to move to much more materials and quantities. And obviously the challenge there is getting that data in. So certainly within your procurement system, start to build that in now if it's not there already. Hotspot analysis, I'm a big fan of this. 80-20 rule, you'll find that 20% of your procurement is going to be 80% of your of actually your carbon liability through your corporate value chain, scope 3s. The Greenhouse Gas Accounting Protocol has guidance around a couple of ways to do that. One's looking at just starting off with who you're spending with, and the amount. Are there obvious high carbon activities? For example, if you steel, cement, these sorts of goods, then that's an area to start focusing on. And if you're still using a spend-based approach, you just need to move away from that straight away. There is another methodology which is carbon hotspotting. It's far more eloquent, and that really allows you to drill down on a supplier and a product by product basis, and certainly recommend that. Also, what will come out of that exercise is it'll give you an opportunity to, who you need to talk to in terms of your suppliers, reaching out to them, seeing if they've got an LCA in place or a product declaration or an EPD. If they haven't, what are their plans to get one? Because this is going to impact them as well. So obviously you can have those conversations earlier, all the better. You do need to look at improving the governance, the review process and controls around emissions reporting. And lastly is just developing those improvement plans. And those improvement plans might be around supplier engagement, taking them on the journey, explaining them, for a lot of them, they may not still know what a carbon footprint is, let alone scope 3, is educating, informing, getting to understand why the compelling event is for you, and get them on board in terms of getting better data and quality carbon information into your inventory. Next slide, thanks. So that's the preamble on what's coming. As I mentioned before, it's a couple of years away, but that's not that long in time, particularly if you've got to change and improve your systems to get ready for it. Obviously, if you can start getting at work in hand earlier, all the better. So what we'll do is we'll stop the recording now, and we'll